Welcome to Iron Financial, where we forge stronger portfolios and cut through market weakness. Today, we're putting Corporación América Airports, ticker CAAP, under the microscope after an earnings report so powerful it created a shockwave across the market. This isn't just a minor beat, it's a seismic event that forced everyone to reevaluate what they thought they knew about this global airport operator. And that's exactly why I'm here. The question we have to ask is simple. Is this explosive growth built on solid iron, or is it just fool's gold? It's easy to get swept up in a headline number, but our job is to look underneath, to check the welds and stress test the foundation. So let's get to it.
Okay, let's dive into this. The headline numbers are frankly staggering. Corporation América Airports didn't just beat analyst estimates for the fourth quarter, it completely obliterated them. This is the kind of report that triggers algorithmic buying and makes portfolio managers spill their morning coffee. It demands our full attention.
Look at this structure. This is the raw power of the report. For the fourth quarter of 2025, the consensus on Wall Street was for earnings per share somewhere around 34 to 38 cents. That was the expectation. The company came in and delivered 65 cents per share. That's not a rounding error. It's a fundamental outperformance that almost nobody saw coming. And it wasn't just some bottom-line accounting trick. Look at the top line. On the revenue side, Wall Street was modeling for roughly $488 million. CAAP posted over $545 million. You're seeing strength flow all the way from the airport's front doors, through their operations, and directly to the bottom line. That's a commanding outperformance across the board.
So, the crucial point is this 91.18% earnings surprise. Let that number sink in. You don't see figures like this every day, not in a mature industry like infrastructure. This is the kind of jolt that forces a complete repricing of an asset. It tells you the market's models were fundamentally wrong. A jolt for sure, I'll give you that. But a sudden surge of power can blow a fuse if the wiring isn't sound. We need to see if this is a sustainable reaction or just a flash in the pan. Let's see if this entire structure holds up under scrutiny.
Absolutely. So let's drill down into the engine room of this growth, because you're right, we need to understand the mechanics. This wasn't a paper profit achieved through financial engineering. It was driven by real-world activity, people getting on planes. Passenger traffic surged, and that's the lifeblood of any airport operator. Now, what's really interesting here is the sheer scale of this growth. A 9.1% year-over-year jump in passengers, hitting 22.3 million people moving through their terminals in a single quarter. To put that in perspective, that's like the entire population of Florida passing through their gates in just 3 months. And this wasn't just one airport having a good holiday season. The source material is clear. Argentina, Armenia, Italy, and Uruguay all hit record traffic levels. This is a story of broad-based strength across their global network. It suggests a resilient and widespread demand for travel is feeding directly into CAAP's ecosystem. And this brilliantly illustrates how they're monetizing that traffic. This is where the story gets even more compelling. Passenger traffic was up 9%, but total revenue growth outpaced it significantly. Aeronautical revenues, fees from airlines, are up over 17%. Commercial revenues, money from shops, restaurants, parking, are up over 16%. They're squeezing more dollars from every passenger. That's operating leverage in its purest form. When your revenues grow faster than your costs, profits explode. And the result of that leverage? A nearly 40% surge in adjusted EBITDA. This isn't just growth, it's highly profitable growth. The machine is becoming more efficient. Their margins expanded by over 7 percentage points to a very robust 45.3%. In an inflationary environment, expanding your margins like that is some serious heavy lifting. It shows discipline and execution. Okay, analyst, those are powerful numbers. I won't deny that. The engine is running hot. But a strong building is tested over time, not just in one storm. And a hot engine can overheat if it's not built correctly. I'm looking at the blueprints of this company's history, and I see some potential design flaws. Let's talk about something that matters just as much as a single data point: consistency, or, in this case, the lack thereof. Was this a genuine structural improvement, or was it just a fluke? Now, this chart tells a very different story, doesn't it? Before this incredible 91% beat, Corporation América Airports missed earnings estimates for 3 consecutive quarters. And these weren't small misses. We are talking about significant disappointments. A negative 49% surprise in Q1, a negative 35% miss in Q2, and a negative 28% miss in Q3. That pattern doesn't scream stability. It looks like a volatile, unpredictable asset. So the core question is this: why should we believe Q4 is the new normal and not just a positive outlier that corrects the average for a very rocky year?
You can't build a long-term investment case on one data point when the three before it are screaming the opposite.
And we absolutely have to address the elephant in the room, Argentina. A significant portion of their business operates in a hyperinflationary economy. This isn't a minor detail. It adds a profound layer of complexity and potential distortion. It's like trying to build a precision instrument on a vibrating platform.
Because of this environment, the company is forced to use a special accounting rule, IAS 29. Think of it like this. If you bought a house for $10,000 30 years ago, and today it's worth $1 million, your original cost is meaningless for understanding its current value. IAS 29 tries to adjust all those old numbers to reflect today's reality, but the key word is adjusts. The US dollar figures we see are heavily processed.
The company itself provides numbers excluding these adjustments for comparison. That tells you everything. When a company has to provide two sets of books to explain its performance, we need to be extremely careful. Is the reported strength real on-the-ground performance, or is it partially an accounting mirage created by currency chaos? I see potential cracks in this armor, and they run right through their biggest market.
An excellent point, Skeptic. And you're right to raise it. Volatility and complexity are risks that have to be stress-tested. So let's do exactly that. Let's move from the income statement with all its adjustments and inspect the actual financial foundation of this company, the balance sheet. This is where the truth lies. Because when the ground is shaking, whether for market volatility or hyperinflation, you need to know how deep your supports go. The first thing I look for is liquidity. Does the company have the cash to withstand a shock, to fund its own growth without begging the banks for money?
They are sitting on nearly $600 million in cash and cash equivalents. Let me be clear, this isn't a company living paycheck to paycheck. This is a formidable liquidity buffer. It's a deep war chest that gives them immense flexibility and security to weather storms and be opportunistic.
Now for the other side of the ledger, debt. And this, for me, is where the bull case gets its steel reinforcement. Their net debt to last 12 months adjusted EBITDA ratio is just 0.7 times. To be perfectly clear for everyone watching, that's like earning $100,000 a year and only having $70,000 in total debt. It's incredibly manageable. A ratio under 1.0x is considered exceptionally strong. In a world of rising interest rates, a company carrying this little leverage is a fortress. The risk of financial distress here is extraordinarily low.
You don't have to take my word for it. The CEO, Martin Ernakian, said it himself. One of the strongest balance sheets in our history. This isn't an accident. It's the direct result of disciplined financial management. And this addresses your concern, Skeptic, head on. Even with the earnings volatility and accounting complexity, the underlying financial structure is incredibly solid. This is the shock absorber.
But a strong foundation is worthless if you're not building on top of it. A fortress is useless if it's not defending a growing kingdom. And what we're seeing from CAAP is an aggressive and strategic expansion of their footprint, locking in long-term growth. This isn't just about one good quarter. It's about a deliberate plan to build a global empire. So you're saying they're deploying that strong balance sheet to actively acquire new long-term revenue streams. This is about the future, not just optimizing the past.
Exactly. And this isn't just talk. Look at their recent execution. In the last few months alone, they secured a major new long-term concession in Baghdad, Iraq. Then, in December, they were awarded the concession for a new international airport in Luanda, Angola. These aren't just dots on a map. They are strategic entries into new growth markets. And while they expand, they are simultaneously fortifying their existing portfolio. They locked in their Armenia concession until 2067. They extended their deal in the Galapagos Islands. This is the playbook of a smart, long-term operator, creating decades of predictable, contracted revenue streams that diversify them away from any single economy.
And let's not forget one other piece of smart housekeeping that boosted this quarter. They received a $32.5 million payment from an arbitration award in Peru. This is important. It resolves a long-standing uncertainty, and it's a direct injection of pure cash that further strengthens that fortress balance sheet. They're cleaning up the past while building the future. So, we've stress-tested the explosive earnings, examined the inconsistent history, and inspected the financial foundation. It's time for the verdict. We've put the company through the iron financial forge. Now let's see what comes out.
Okay, let's lay it all out. The bear case, my case, is that the historical inconsistency is a major red flag. It's hard to trust one stellar quarter after 3 bad ones. Add the complexity of their Argentina operations, with hyperinflation accounting potentially distorting the true picture, and you have tangible risks that could burn investors. And the bull case is that while those concerns are valid, they are overwhelmed by the evidence of fundamental strength.
You have record passenger traffic. You have a monster earnings beat driven by operational leverage. You have substantial margin expansion. But crucially, you have the ultimate backstop, the fortress balance sheet. The deep cash reserves and rock-bottom 0.7x leverage act as the shock absorber for any of that volatility. And on top of that defense, you have a clear offense, an aggressive global expansion strategy, adding new long-term assets to the portfolio.
So is this an opportunity or a trap? Our verdict at Iron Financial is that the strength is real. The concerns about consistency and Argentina are what keep this stock from being even more expensive. They are known risks that the market is, to some extent, pricing in. So you're saying the risks are the price of admission for the potential reward? That the market's fear is creating the opportunity? Precisely. The balance sheet is the proof. It's the verification that this company is built to withstand turbulence. They have the financial firepower and the strategic vision to keep building. That Q4 performance, seen through this lens, looks less like a fluke and more like a sign of the operating leverage finally kicking in across their entire growing network.
The market is taking notice, but the real question investors must now ask is whether this powerful quarter is the start of a new, sustained era of profitable growth for Corporation América Airports. The foundation is iron, the engine is roaring, and the roadmap for expansion is clear. That's our analysis. As always, do your own homework and forge your own conclusions. We'll be back to stress test the next set of numbers. This is Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.